Picture this. Your family owes $200,000 on a mortgage, carries $50,000 in credit card debt, and just took out another loan for a new car. Any financial advisor would tell you to pay it all off as fast as possible, cut spending, and live debt-free. Now imagine discovering that every single government on Earth does the exact opposite. They do not aim to permanently pay off their debt, but instead keep borrowing more, and somehow this makes their economies stronger. This isn't just counterintuitive, it's a complete inversion of everything we think we know about money. The numbers are staggering. Japan carries debt worth 256% of its entire economic output. That's like a family earning $50,000 a year owing $130,000. Yet Japan maintains one of the world's most advanced economies. The United States refinances $28 trillion every 4 years, rolling old debt into new debt in an endless cycle that never stops. Britain carried debt from the Napoleonic Wars for over 200 years before finally choosing to pay it off in 2015, and that was optional, not necessary. Every government operates this way, every single one, and markets price this behaviour as normal, healthy, even essential. This discussion is for educational and analytical purposes only, and does not constitute financial advice. This matters because if you understand money the way most people do, as something that should be saved, managed carefully and eventually paid back, then government behaviour makes no sense. But if governments are right, and household financial wisdom is wrong when applied to national economies, then everything we think we know about debt, growth and economic stability needs to be reconsidered. The gap between these two realities creates profound misunderstanding about how modern economies actually function. Most people assume governments would pay off debt if they could, but choose not to because of political pressure or poor planning. That assumption is backwards. Governments don't pay off debt because paying it off would damage their economies. The debt isn't a burden they carry despite economic success. It's a tool they use to create economic success. And the reason this hasn't been reflected in price yet is not what most people assume. The conventional story makes perfect sense on the surface. Governments borrow money during emergencies like wars, recessions or pandemics. They issue bonds to investors who lend them money in exchange for interest payments. When the bonds mature, governments pay back the principal plus interest just like any other loan. The expectation is that once the emergency passes, responsible governments will reduce spending, increase taxes if necessary, and gradually pay down what they owe. This narrative explains most of what we see. During World War II, the United States borrowed heavily to fund the war effort, pushing debt levels over 100% of economic output. After the war, debt as a percentage of the economy fell dramatically, from 106% in 1946 to 23% in 1974. Britain borrowed extensively during the Napoleonic Wars, issuing special bonds to finance the military campaigns that eventually defeated Napoleon. These examples suggest the system works exactly as intended. If you're interested in understanding markets beyond headlines, this channel focuses on exactly that. The pattern appears across developed nations. Germany, France, Canada, and the United Kingdom all carry substantial debt loads while maintaining stable, prosperous economies. When debt levels rise during crises, they eventually fall back to manageable levels. Investors continue lending to these governments at reasonable interest rates, indicating confidence in their ability to repay. Credit rating agencies assign top ratings to government bonds from major economies, treating them as the safest investments available. The refinancing process seems straightforward. When government bonds mature, new bonds are issued to replace them. Interest rates fluctuate based on economic conditions and investor confidence, but the basic mechanism remains consistent. Governments that demonstrate fiscal responsibility by controlling spending and maintaining economic growth can borrow at lower rates. Those with weaker finances pay higher interest, creating natural incentives for sound policy. Even the massive numbers involved make sense within this framework. $28 trillion sounds enormous, but spread across the largest economy in human history and refinanced over many years, the payments become manageable. Japan's debt appears unsustainable at first glance, but Japanese investors hold most of it domestically, and the government pays interest in currency it controls completely. This is the part most people understand. The part that actually changes the outcome comes next. The standard explanation misses the fundamental structure of how government debt actually works. Unlike household debt, which represents a claim on future income that must eventually be repaid, government debt represents something entirely different. It is the primary mechanism through which money enters and circulates within the economy itself. When governments spend money they don't have, they create that money by issuing bonds. The bonds become assets held by investors, banks, pension funds, and foreign governments. The money spent becomes deposits, wages, and payments that flow through the economic system. This isn't borrowing in the traditional sense. It's money creation, with an interest-bearing government bond produced as the byproduct. Consider what happens when a government pays off debt completely. The money used to purchase the bonds gets destroyed, removed from circulation permanently. The bonds that served as safe, interest-bearing assets for investors disappear. The steady flow of interest payments that supported pension funds, insurance companies, and savings accounts stops. Rather than improving the financial system, debt repayment removes its foundation. This explains the post-war debt reduction that seems to contradict the pattern. The United States didn't actually pay off its World War II debt through fiscal discipline. Instead, economic growth and inflation reduced the real value of the debt, while keeping the nominal amount roughly stable. What appeared to be debt reduction was actually economic expansion, making the existing debt smaller in relative terms. The debt itself remained, continuing to serve its monetary function while becoming less significant compared to the overall size of the economy. The British example reveals the same dynamic. Those Napoleonic war bonds weren't paid off because they became burdensome. They were redeemed in 2015 because interest rates had fallen so low that the government could borrow more cheaply by issuing new debt. The decision was purely financial optimization, not debt elimination. Britain immediately replaced the old bonds with new ones, maintaining the same debt level while reducing interest costs. Japan demonstrates this principle at extreme scale. With debt at 256% of economic output, conventional analysis suggests impending crisis. But Japanese debt serves as the backbone of the domestic financial system. Japanese banks, insurance companies, and pension funds depend on government bonds as their primary safe assets. Paying off this debt would collapse the financial sector by eliminating its most important asset class. The refinancing process isn't temporary borrowing that will eventually end. It's the permanent mechanism through which monetary systems operate. Governments don't roll over debt because they can't afford to pay it off. They roll it over because the economy requires continuous debt issuance to function. Each refinancing cycle creates new money while providing safe assets for the financial system. Interest payments aren't a burden that drains government resources. They're transfers that distribute purchasing power throughout the economy. When governments pay interest on their debt, that money becomes income for bondholders, who then spend or invest it, creating economic activity. The interest flows support everything from retirement savings to university endowments to foreign exchange reserves. On the surface, everything still appeared to make sense. But the deeper structure reveals why this system can never actually resolve the way traditional analysis suggests. The refinancing mechanism that appears to manage debt sustainably actually creates escalating dependencies that compound over time. Every refinancing cycle increases the total amount of debt that must be rolled over in future periods. When governments issue new bonds to pay off maturing bonds, they typically borrow slightly more than the amount being repaid to cover interest costs and new spending. This means the stock of debt requiring refinancing grows with each cycle, even when governments run balanced budgets on new spending. The maturity structure amplifies this pressure. Over 20% of United States government debt matures within 1 year, requiring continuous refinancing of massive amounts. A record $8.9 trillion of government debt will mature in the next 12 months alone. This short-term waiting means governments cannot simply wait for economic growth to make debt more manageable. They must actively convince investors to purchase new bonds every few months to prevent default. Interest rate environments determine the sustainability of this process. During periods of low rates, refinancing appears effortless. Governments can roll over debt at favourable terms while maintaining or even reducing their interest burden. But when rates rise, the same debt becomes exponentially more expensive to service. A small business that borrowed at 3% in 2020 faces rates that are double or triple when refinancing today. Governments experience the same dynamic, but at scales that dwarf private borrowing. The investor base that purchases government bonds creates additional constraints. Central banks, foreign governments, pension funds, and insurance companies buy bonds for different reasons with different tolerance levels for risk. When any major category of buyers reduces demand, governments must either pay higher rates to attract replacement buyers or risk failed auctions where insufficient demand materializes. The system depends on continuous confidence from multiple types of institutions with conflicting priorities. Currency considerations add another layer of complexity. Countries that borrow in their own currency can theoretically create money to service debt, but this approach triggers inflation that erodes the value of existing bonds. Investors demand higher yields to compensate for currency debasement, making future borrowing more expensive. Countries that borrow in foreign currencies face even starker constraints, as they cannot create the money needed for repayment. The mathematical progression becomes clearer when examining actual numbers. Japan's debt-to-GDP ratio of 256% means that even with zero interest rates, maintaining current debt levels requires bond issuance equal to over twice annual economic output just for refinancing. Any increase in borrowing costs makes this arithmetic increasingly difficult to sustain. Credit rating agencies monitor these dynamics, but their assessments lag behind underlying pressure. Ratings reflect current ability to service debt, not future sustainability under stress conditions. When agencies finally downgrade government debt, the higher borrowing costs accelerate the very problems that triggered the downgrade, creating feedback loops that conventional analysis struggles to capture. The political economy of debt management reveals additional pressure points. Governments that attempt to reduce debt through austerity often trigger recessions that shrink the economic output used to measure debt sustainability. Cutting spending reduces economic activity, which can make debt ratios worse even when absolute debt levels decline. This dynamic has trapped numerous countries in cycles where fiscal responsibility produces fiscal deterioration. International coordination affects the entire system simultaneously. When multiple major economies attempt to reduce debt at the same time, global demand for bonds decreases while supply increases. This coordination problem means that debt reduction strategies that might work for individual countries become self-defeating when pursued collectively. The reserve currency status of certain bonds creates additional dependencies. United States Treasury bonds serve as the foundation for international trade and central bank reserves worldwide. Reducing the supply of these bonds would disrupt global financial plumbing in ways that extend far beyond American fiscal policy. Other countries depend on dollar-denominated debt markets for their own financial stability. Financial institutions build their entire business models around the existence of government debt. Banks use government bonds as collateral for lending, as liquid assets for regulatory requirements, and as benchmarks for pricing other investments. Insurance companies match long-term liabilities with long-term government bonds. Pension funds rely on the steady income streams that government bonds provide. Eliminating or significantly reducing government debt would require these institutions to completely restructure their operations. The derivatives markets that have developed around government debt create additional barriers to debt reduction. Interest rate swaps, credit default swaps, and other instruments worth hundreds of trillions of dollars reference government bonds as underlying assets. These markets provide crucial risk management tools for corporations and financial institutions. Disrupting the government bond markets would cascade through derivative markets in unpredictable ways. Modern monetary systems have evolved to depend on government debt issuance as a primary mechanism for money creation and distribution. Commercial banks create money through lending, but government spending provides the base money that supports this process. Reducing government debt issuance would constrain the money supply in ways that could trigger deflation and economic contraction. The timing of debt maturity creates additional complications. Unlike corporate debt, which can be restructured or discharged through bankruptcy, government debt must be honoured to maintain the credibility necessary for future borrowing. This means governments cannot simply default selectively on expensive debt while maintaining cheaper borrowing. Each bond must be paid or refinanced according to its original terms. Historical precedents for large-scale debt reduction reveal the constraints involved. The few examples of major economies significantly reducing debt occurred during periods of exceptional economic growth, financial repression, or unexpected inflation that eroded debt values in real terms. These conditions cannot be engineered deliberately without significant economic disruption. If this kind of structural analysis is useful to you, subscribing helps you stay ahead of the signals markets usually notice last. The system operates within these constraints rather than resolving them. Governments continue refinancing because the alternatives would destabilize the entire financial architecture that modern economies depend upon. The debt persists not because politicians lack discipline or investors demand it, but because the economic system has evolved to require it as a foundational element. This is where the same forces that drove growth begin to reverse. The refinancing cycles that appeared manageable during decades of declining interest rates now operate in a fundamentally different environment. Central banks that once provided unlimited demand for government bonds through quantitative easing programs have shifted to quantitative tightening, actively reducing their holdings. This transition removes the largest and most reliable buyer from bond markets precisely when governments need to refinance record amounts of debt. The Federal Reserve purchased trillions of dollars in government bonds during successive rounds of quantitative easing, creating artificial demand that suppressed interest rates below market levels. As these programs reverse, the Fed now sells bonds back into markets while governments simultaneously issue new debt. The combined supply overwhelms natural demand from pension funds, insurance companies, and foreign buyers who cannot absorb the volume at previous pricing levels. International buyers face additional constraints that reduce their capacity to purchase government debt. Foreign central banks that once accumulated dollar reserves as a matter of policy now diversify away from concentrated dollar holdings. China, historically the largest foreign holder of United States Treasury bonds, has reduced its holdings substantially as trade relationships shift and domestic investment opportunities improve. European buyers confront their own fiscal pressures as aging populations increase social spending while economic growth stagnates. The demographic transition accelerates these pressures across developed economies simultaneously. Pension funds and insurance companies that provided steady demand for government bonds now face liability structures that require higher returns to meet obligations to aging populations. These institutions cannot continue purchasing low-yielding government debt when their actuarial requirements demand higher income streams. The mathematical mismatch between available yields and required returns creates a structural shortage of willing buyers. Corporate demand for government bonds diminishes as companies optimize cash management for higher rate environments. During the era of near-zero rates, corporations held government bonds as cash equivalents that provided modest returns with perfect liquidity. As corporate borrowing costs rise, companies prioritize debt reduction over bond accumulation, removing another category of reliable buyers from government debt markets. The auction mechanics reveal the strain building within the system. Primary dealers who facilitate government bond auctions must temporarily hold inventory between government issuance and final buyer placement. As auction sizes increase and buyer demand becomes less predictable, dealers face greater inventory risk that requires higher compensation. The bid-to-cover ratios that measure auction demand have deteriorated gradually, indicating that governments must offer higher yields to clear the same debt amounts. Secondary market liquidity conditions compound these primary issuance challenges. Government bonds traditionally served as the most liquid financial instruments, easily traded in large quantities without significant price impact. As dealer inventory capacity shrinks and trading volumes concentrate in shorter maturity bonds, liquidity deteriorates precisely when governments need maximum market access. Reduced liquidity increases the risk premium required by investors, further raising government borrowing costs. The currency implications extend beyond individual countries to the international monetary system itself. United States dollar dominance depends partly on the depth and liquidity of Treasury bond markets that provide safe assets for global reserves and trade settlement. As Treasury issuance increases while buyer demand fragments, dollar liquidity conditions tighten in ways that affect global financial stability. Other major currencies lack the market depth necessary to absorb the reserve asset functions that Treasury bonds currently serve. Credit rating pressures intensify as the mathematical constraints become more visible to rating agencies. While current ratings reflect historical payment performance and economic fundamentals, the forward-looking refinancing arithmetic presents challenges that traditional analysis struggles to incorporate. Rating agencies must balance acknowledgement of fiscal constraints against the systemic importance of maintaining government bond ratings that underpin global financial architecture. The political constraints on addressing these pressures create additional instability. Governments that attempt to reduce debt through spending cuts often face electoral consequences that reverse fiscal consolidation efforts. Tax increases sufficient to meaningfully reduce debt loads require political consensus that becomes more difficult to achieve as economic growth slows and debt service costs consume larger portions of government budgets. The democratic process provides few mechanisms for implementing the sustained austerity that debt reduction would require. The system doesn't fail here, it tightens. Nothing breaks overnight. Pressure builds quietly, one refinancing cycle at a time. Markets continue pricing government debt as the ultimate safe asset, while the structural mechanics that enabled this perception operate under increasing strain. Bond yields remain anchored to historical relationships that assumed unlimited refinancing capacity and perpetual buyer demand. Credit spreads reflect current servicing ability rather than future rollover constraints under stress conditions. The mispricing persists because the alternative requires acknowledging that the foundation of modern monetary systems contains inherent mathematical limitations. Central banks maintain confidence through communication strategies that emphasize flexibility and unlimited capacity, while quietly managing increasingly complex auction dynamics. Rating agencies preserve AAA classifications that institutional mandates require for fiduciary compliance, creating circular dependencies that resist reassessment. Confidence remains intact because the costs of losing confidence exceed the costs of maintaining current trajectories, at least in the near term. Pension funds cannot acknowledge that their safest assets might not remain safe without triggering liability crises that dwarf current fiscal pressures. Insurance companies cannot reprice government debt risk without restructuring product offerings that depend on predictable income streams. Foreign central banks cannot diversify reserve holdings without disrupting currency stability that their domestic economies require. What would force reassessment involves stress conditions that make refinancing arithmetic visible to market participants who currently assume it away. Failed bond auctions, forced yield increases that break institutional return assumptions, or coordination failures among major buyers could trigger rapid repricing across global debt markets. The mathematical constraints operate continuously, but market recognition requires catalytic events that overcome institutional incentives to maintain current pricing frameworks. The household financial wisdom that government behavior appears to contradict actually applies at a different scale and timeline than market participants currently recognize. The debt never gets paid off because the economic system evolved to prevent it, but the pressures that prevent repayment also accumulate constraints that compound over time. Government debt functions as money, until the system treating it that way breaks. This is what remains unpriced for now. If this helped clarify how the system actually works, consider sharing it with someone who follows markets closely.